Let me hit you with something wild. A simple coin toss using a basic 1-to-1 risk to reward actually performs better than 80% of retail traders. Read that again. If that doesn't make you rethink everything you know about trading, nothing will. Picture this: a trader who literally flips a coin to make decisions. Heads equals buy, tails equals sell. Every trade risks $1 to make $1. Stop loss at -1, take profit at +1. No charts, no analysis, no gut calls. Just pure randomness and emotion-free execution. And according to multiple studies and brokerage data, this totally brain-dead, robotic, random approach still beats most traders. Why? Because humans struggle with uncertainty so much that a coin ends up doing a better job. Now the math: a true 50-50 coin flip with a 1-to-1 RR has zero expected value. Not positive, not negative, just break even over the long run. Flip a coin 100 times, you win about 50, lose about 50. Risk $10 each time, you lose around $500 and win around $500. You end at break-even minus fees, basically hovering around zero. Even if you change to a 1-to-2 or 1-to-3 risk reward, the overall expectation stays zero. Your win rate simply drops to compensate, still mathematically neutral. But here's where things get uncomfortable. If this neutral, zero-edge strategy beats 80% of retail traders, what does that tell you? It means the majority aren't just failing to make money, they're losing so consistently that randomness would save them. Most retail traders blow their accounts within a year. Studies show 75 to 90% lose money. Those who survive usually slowly bleed their capital before eventually quitting. So why does a coin outperform actual people? Because the coin has something humans don't: perfect execution through variance. Variance equals the natural ups and downs that every strategy experiences, no matter how good it is. Winning streaks that feel amazing, losing streaks that feel like doom. The coin doesn't care. Humans do. And that's the entire problem. Most traders fall apart during losing streaks. They start doubting themselves. They break their plan. They adjust position sizes based on emotion. They skip setups after losses. They revenge trade to make money back. Every emotional decision destroys their edge. Meanwhile, the coin never hesitates, never gets scared, never gets greedy, never changes behavior after a streak, takes every setup, avoids every non-setup, sticks to perfect consistency. That's why the coin stays near break-even, while the average trader drifts far below it. Take 1,000 trades and compare. Coin at 1-to-1 around break-even human trader often ends around minus 0.4 R per trade. The coin wins not because it's smart, but because it never sabotages itself. This leads to the core truth. Having an edge means nothing if you can't execute it. You can have a system with a real statistical advantage, but without emotional stability, your actual results will still be negative. A back test might show plus 0.5 R, but your real trading might be minus 0.2 R, simply because you don't stick to the plan. That's why a dumb coin flip beats most traders. Not because the coin is superior, but because it's emotionless and consistent. And this is where the difficulty really shows up, especially when you increase your risk to reward ratio. At 1-to-1, you win about half your trades. Feedback is quick. Losses feel manageable, but at 1-to-2, your win rate falls to around 33%. That means you lose 2 out of every 3 trades. Can you handle that emotionally? At 1.3, your win rate drops to roughly 25%. Now you might lose 6, 7, or even 8 trades in a row, and that's still completely normal variance. The math hasn't failed. Your psychology has. Because after a streak of losses, your brain starts whispering, Maybe the system doesn't work anymore. Maybe I should take profits earlier. Maybe I should skip the next trade. And the moment you listen to that voice, you destroy the statistical structure of your strategy. A 1 to 3 system needs those big winners to survive the losing streaks. If you cut your winner early at 1 to 1, you've turned a once profitable idea into a guaranteed loser. This is why higher R ratios destroy most traders. Not because the math is wrong, but because the psychological load becomes too heavy. So here's the real lesson. If you can't execute a simple 1 to 1 system with consistency, you have no business trading a 1 to 2 or 1 to 3 system. Your RR should match your emotional tolerance, not what looks impressive. Most beginners should start with 1 to 1 RR, not because it's better, but because it's psychologically sustainable. Now let's talk about what actually matters in trading, because if technical analysis beyond the basics has diminishing returns, and if strategy isn't the holy grail everyone believes it is, then what truly separates profitable traders from losing ones? The answer: execution discipline. This means taking every valid signal. No skipping trades because you're scared. No taking random trades because you're bored. No adjusting your stop loss after entry. No over-leveraging when you're confident. No cutting size when you're nervous. Just pure mechanical consistency. The coin flip has perfect discipline because it doesn't have feelings. It can't hesitate. It can't get emotional. It can't break rules. And that's the level of neutrality you must develop. This leads directly into risk management, which isn't just about using a stop loss. It's about risking the same amount on every trade, not 1% when you feel good and 0.5% when you're scared. If losing 1% makes you panic, you're risking too much. Your risk per trade should be small enough that a loss feels like a gentle nudge, not a punch to the chest. Next comes emotional neutrality, the hardest skill in trading. This is the ability to see each trade as just one data point in a large sample size. Wins mean nothing. Losses mean nothing. The coin has this built in. You need to train it. Most traders quit after 10, 20, or 30 trades. But to see your real edge, you often need 500 or even 1,000 trades. The coin doesn't care about short-term results. It just keeps flipping. You need the same long-term commitment. All of this comes together into the ultimate concept: process over outcome. A losing trade executed perfectly is a win. A winning trade executed poorly is a failure. Most traders get this wrong. They judge themselves on profit or loss instead of execution. But trading is a probabilistic business. You can make a perfect decision and still lose. You can make a terrible decision and accidentally win. The only thing that truly matters is whether you followed your rules, because your long-term results come from process consistency, not short-term outcomes. This is the part no one teaches. It's not sexy. It doesn't sell courses. It doesn't make for flashy thumbnails. But it's the real difference between the 20% who succeed and the 80% who fail. Here's the truth most traders avoid. You are the problem, not the market, not your broker, not the institutions, not your strategy. You, your fear, your impatience, your need to be right, your emotional reactions, your inability to follow your plan consistently. A coin doesn't have these flaws. That's why a coin can outperform you. But here's the good news. These are solvable problems. You can build discipline. You can control your emotions. You can develop long-term patience. Trading is a performance skill, like sports or music, where your mindset matters as much as your technique. The coin flip example is meant to destroy illusions, to show you that trading success has far less to do with prediction and everything to do with execution. Successful traders aren't the ones with the most complex strategies. They're the ones who show up every day and follow a boring, consistent process without getting in their own way. Because at the end of the day, trading isn't about outsmarting the markets. It's about mastering yourself. The coin doesn't try to predict anything. It just flips with perfect consistency, perfect discipline, and zero emotion. That's the trader you must become.